part. But I'd like to give some time at the end for a few questions and answers. So we're gonna get started right now, and I will let you folks introduce yourselves.
Ladies first.
Thank you. I'm Sharon Brobst. I work for Bassings over in South Portland, over in the Mill Creek area. I am a retail lender to mortgage and consumer loan, residential, not commercial. And I have been, do I say it? 41 years. I didn't get this gray hair, but no. So it is not premature. And really glad to be here for you.
Adam Carrier. I'm the regional mortgage sales manager with Infinity Credit Union. And I'll actually just let everyone know we are going through a name change with Infinity Credit Union. We are officially now M People Credit Union. One word, EM People. We're empowered financial solutions for our members. Okay. So M People. But I've been there again 16 years. I focus on residential mortgage solutions, and I have a dynamic team that helps me to bring those clients to the finish line. I'm happy to be here today.
Good afternoon. My name is Steve Lavallee, and I am with Integrity Mortgage. One of the questions that we were asked to talk about is what type of lender are you? So Integrity Mortgage is we're a correspondent lender, which means I've sat in the same little office in Yarmouth for 17 years, 18 years, and gone through a bunch of name changes. I've been a mortgage broker, I've been a mortgage broker owner, and now we're a correspondent lender. And there's advantages and disadvantages to all of them. But when you're a mortgage broker, what I liked is we could kind of shop around and find a good fit for you, which was great. But what I didn't like is then we would take the file and you ship it to whichever lender you decided to go with, and 99% of the time it's out of the state of Maine, and you lose a little bit of control. As a correspondent lender, we at Integrity, which is really a combination of the mortgage office, which I had in Yarmouth, First Financial Mortgage, which is right across the street, and Approved Home Mortgage, which has been around in Falmouth and in Portland for a long time. As a correspondent lender, we're able to do 90% of the under here in Portland, process and close loans right here locally. So we're all local on the vast majority of our loans, which I like. So that's it.
And I'm Patrick Cannon with Caliber Home Loans. You may notice that I'm originally from around. We moved to Maine almost 8 years ago and did it for the quality of life. It wasn't a job. It wasn't, I was wanted in several states or anything like that. But we absolutely love it up here. I've been in the mortgage industry about 7 years now. And I'm a loan consultant. Our company, we're a national company, but a local presence. And we are just leading into one of the questions that we were given. As the way we're structured is we are a mortgage lender. So we are certified directly with Fannie Mae and Freddie Mac. We do all of our own internal underwriting. Everything's handled within our organization. And then another piece to it as well is we actually service about 90% of our loans, which means we have a $551 billion servicing portfolio, which gives the company a lot of resources and a lot of stability. So that's one of those things that allows us to be very sharp on rates and be really, really mindful of our fees, because we all know that things are getting more expensive out there and it's tough on everybody.
Where'd you move up from?
Atlanta.
There you go.
Yes, lived in Atlanta for 48 years and spent about 25 years trying to get out.
Oh, that's awesome. Well, we're gonna get started with the questions. We've got a variety here to pick from, and the lenders have all seen the questions. So there's no surprise attack here or any of that. They're all aware of the questions. It would be nice to give them a zinger of a question that would stump them, but these guys are so experienced, there's no so I'll start with Sharon, and then have the rest of you folks answer. How has lending changed in the last 6 months?
I have that one.
So I would like to just say that I saw Sharon a week ago or whatever. She's the type of person in high school you didn't want, either you wanted to sit next to or you didn't want her in your class because she had already written out all her answers. And everything. It's like Sharon, I can't even find the questions. Never mind write the answers. So I said, most of my answers are going to be deferred.
Deferred to me.
We'll just agree with what she.
Yeah.
All right, so that was number 9. Okay,
Yeah.
I think that is, hang on just a second. Hang on. See, sometimes it's not, okay.
Rates have gone up in the last 6 months.
Yes.
Yeah.
Oh, okay, it's number 2, okay, that's fine.
Yeah.
Okay, changes, here we go. There's definitely a reduction in volume, of course, as you guys know, because of the limited inventory for purchases. As well as, refinance requests. Generally, what I see with refinances is if there's a divorce situation, if they really need to get the equity out for some reason and it's the best option for them, that kind of thing. But generally speaking, 2020, pretty much anyone who had a mortgage refinanced at that time, down to the 3s. So refinances are not as much. And so we at Bath are seeing an uptick in construction loan financing, especially for those who actually own the land or have a purchase with a construction package. So that's what we're certainly seeing. And we are seeing more land loans themselves, that kind of thing. So.
Good.
Yeah, definitely the last 6 months been a big shift. As you mentioned, low inventory, demand's down. Rates with that increase in rates, like I was sitting beginning of the fourth quarter last year, I was still doing like 5/1 ARM at 3.99. We went all the way as high as 6-7% for 30-year fix. So you said refinance. You had to get a little more creative just finding the need. I will say, like I had a scenario the other day where it made sense. Somebody refinanced their first mortgage. It was at a 2.899 rate.
Wow.
But they needed $25,000 out for home improvement. They had credit card debt to consolidate. They had a home equity with, again, the prime rate's a big change with this too. Prime getting all the way up to now, what, 8.25?
Yeah.
Like home equities with interest only payments. That was a big impact on our members that it doubled essentially from this, from the time 6 months ago. So the pipeline shifted to more of a purchase pipeline, obviously. But again, the inventory concern is still there. Buyer demand is there. We have so many pre-qualified buyers right now in the market. It's just no houses, and things have shifted, right? People, builders aren't necessarily with building single family. Now they might be building more rental properties because there could be more bang for their buck for rental income. And there's just not enough skilled trades to keep up with the construction needs. People aren't moving out of their houses because they want to keep that great rate, and where are they going to go? So inventory is that is the name of the game, I think, right now. And I'm really hoping, fingers crossed, spring market, some things change, but we know what the issues are. It's just, you keep your, stay going with it.
Yeah, I mean, these guys all exactly. The quick answer, or the easy answer for me is it's not as much fun. Where it's, we're dealing with, if we do a refinance, it's huge. It was great when we're saving people $300 a month and you're able to pay off, right now refinance, it's usually a life change and oftentimes a divorce, which is no fun, or they got themselves in credit card trouble or something. So that we do purchases, which we're all still doing business. They're kind of, but they're like, oh, did I overpay? And oh, I don't, this, and oh, geez, I sold in Cleveland and 3.5%. Now you're telling me it's 6.5% or higher. So it's people just are a little grumpier, I think. We all are, maybe. So it hasn't been as much fun. I concur with the volume and this and that, but not as much.
Yeah, I would certainly have to agree with everything that's been said up to this point. And I think one of the key takeaways on our side of the house, I'm sure you're seeing this as well, is that the education of the consumer or the borrower or the client or whatever has become so much more important because people are frustrated. They see headlines, which we know that, headlines are meant to grab eyeballs, they're not meant to actually communicate information. And so it's become all that much more important for us as loan officers to engage with the client, talk with them about what options are out there. I was in a presentation last Friday. The National Association of Realtors did a survey of first-time buyers. Only 11% of them knew that you didn't have to put 20% down on a conventional loan. Yeah, that's
Okay.
crazy. Now, if you had told me 50% didn't know, okay, that's one thing, but only 11% didn't know that there are 3 and 5% down options, which is crazy. They're either looking at Google or, and I kid you not, I have this right now. Her uncle, who last bought a house in 1974, is convinced he knows everything. And he's filling her head full of, no, you can't actually do that. Okay, well, so, but at any rate, the level of engagement that we need to put in to help your clients understand what their options are and to, help them feel maybe a little bit more optimistic about what maybe they can do, has become all that much more important as well. So, ultimately it comes down to fees and rates and everything else, but the education and understanding options is absolutely critical.
Great, thank you. Uplifting too.
Yeah, the truth. Yeah.
Yeah, the truth does hurt. So the next question is, does your company offer any special financing for first-time buyers?
You want me to go first?
Yeah,
Okay,
sure.
that's fine. So we are a mainstay housing lender. So that currently is at 5.5, which is obviously discounted from the norm. And with that, it can be tied with rural developments, mortgage insurance. That's 0% down. And the actual insurance itself is actually more affordable than if you went FHA. I've done the math. With FHA financing, they have to do 3.5% down. And then with the way that the fees work, the payment is actually higher with a down payment than it is with no down payment in main housing and with RD. So it's interesting how that works. The only difference really with that is it can't be Portland, South Portland, or Westbrook in this area because they're not considered rural. It's in the title. So there's that, right? But for most folks, that seems to be a really good option for people. One of the things with main housing is that if you do take the first time home buyer class, which is, by the way, brochures over there, homeworks, homeownership education, what Patrick was just talking about.
Yep.
It's all right here, 8-hour class. They get $5,000 for their costs. So if they use main housing. So that's the biggest piece that we have. We also have, portfolio 10x1 that's a 3% down, that kind of thing, depending on what the income eligibility is for people. Sometimes the income is too high for them to be able to do main housing. So that's kind of what we have going on for first-time buyers. And we do VA, main housing VA as well, and that's 0% down
5% rate
and 5.5 with main housing.
for solutions.
Oh, that's right.
Yes.
Just 0.5% off.
I
Right?
just did one.
Yeah, that's right. So that's really kind of cool with what main housing is willing to do. If anyone is a veteran, they don't even have to have VA financing, but if they can prove they're a veteran, they get 0.5% off the rate.
What's the qualification to be a veteran?
They have the DD 214, which is
DD
honorable.
214.
Yeah, DD 214.
I don't know.
But
Right.
what that is honorable discharge,
Okay.
or if they're active
Like
service members.
my husband was in the Air Force for 4 years. I mean,
Yeah.
he didn't.
Yeah,
He didn't.
and he very well may.
So,
VA.gov. He can check with them.
no, I mean, not looking, but
I know.
he said that he's not qualified for a number of things when it says veterans.
Right.
Get this or
Right.
that. He said, I was just in
Yeah.
it for 4 years to get
So-
the GI.
Ultimately, they do need to have a certificate of eligibility. Generally speaking, if they have a DD 214, the lender can check to see if they do have that certificate of eligibility.
One quick note about VA too is it's going to depend on when the veteran was in the service, because the requirements shifted from World War II to Vietnam through like 72 to 81, and then 81 to Desert Storm, and then since then. So the requirements are all a little different, but just like Sharon was saying, E-214 and the veteran can actually submit it and obtain the certificate of eligibility that will confirm whether or not they can get.
Those are the two big first
Those are the two big documents.
documents that you're driving around your car with some of the things they want to do a VA loan. You would want to ask them, hey, go online and do you have a DD 214 or a certificate of eligibility.
And there's also a local rep for that too. There's a local Veterans Administration. My husband and my father who passed away, my husband who's living out is Army
Okay,
and Air Force. And we did VA loans and there was a local rep that actually helped us with all the documentation because it's not easy.
Yeah, it's gotten a little better, but yeah.
There's a local office and they'll set you up with someone and they'll help you with everything.
nice.
Well, in People Credit Union, I gotta get used to
And
saying.
people-
it. Roll right off the tongue.
Yeah.
Well, we're a conventional lender, so we don't have the government programs on our end. Historically, we have had a unique first-time homebuyer program. We call it our Rent Buster program. And this was an adjustable rate mortgage, 80% on the first mortgage, 20% of the purchase as a fixed rate home equity loan. So 100% financing, no MI. This is one of the things, though, I will say, the 6 months change, what's happened? We've had to pause portfolio solutions. So those normally we would just keep on the books. We don't sell them. We sell fixed rate first mortgages. Right now, we are just doing fixed rate. So for the time being, 3% down for first time home buyer. We can still get them into a program like that. I would say one of the big differentiators is as a credit union, a financial institution, a lot of it is the preparation, helping people to understand the process, get qualified. If their credit's not quite to be out, their savings isn't quite where it needs to be at, we can help coach them, get them the services. We have the products to make people qualified buyers and ready to go. So building that confidence, helping them pre-mortgage, and then after the mortgage, actively managing the mortgage as they have a membership through the credit union. If you bank with us, if you have the mortgage with us, it's a really nice, unique combination. But we do a great job with the first time home buyers and our realtor partners with that.
Great.
Yeah. As we all know, first time home buyers, I just feel so bad for right now.
Yeah.
I've got
Oh.
kids that are in that age and it's sad. So great programs, Maine State Housing, but they're strict on debt to income ratios. And when your first house now is 440
Yeah.
and putting no money down or that it kicked a lot of people out. And there's income, yeah, right. And there's income caps on it. So it's hard to, we have access to a 5% down first time home buyer with no mortgage insurance. So that's kind of neat. And then FHA, which I used to not be a fan of, but I kind of think it's gotten a little bit better. 3.5% down, they've reduced their monthly. And again, I think all of us say it is get in the house now, and in 2 years, hopefully we can refinance or restructure or whatever. So what's the good thing about FHA is they're very liberal in their credit score
Right.
issues and their debt to income issues, which is both good because you can get them in, but it's scary putting first time home buyers with very high debt to income ratios. And if one little thing goes wrong, you kind of worry, or I worry about them. I did bring some things on credit scores, and like people thinking they have to put 20% down. It's amazing what people really don't understand about credit scores. And I literally, two kind of interest scores had three. One, I'm old enough now where I'm starting to pre-qual my friends' children.
Yeah.
Kind of, I
Yeah.
don't know. And his dad's relatively conservative, successful. He's relatively successful, conservative. And he had he's 28, had just gotten his first credit card 6 months ago and had no other credit.
Oh, no.
So his scores were, and it's like, I go out and get a new credit card, tell your one credit card you do have, bump up the limit.
Right.
So you want as high a limit as you can get. And so there's that one, and don't close any credit cards. The other kind of fun thing is, nice thing is, and we probably all can do it, but we certainly can, is we have this what if simulator. So when we pull a credit, and the guy in my office did this last Thursday, people are under contract, they can get a loan, they were just under 650. Our what if simulator, we pull all this, I would think he's a tri-merge credit report, Experian, Equifax, TransUnion, gives you a score, but it also says what you might be able, how many points you might be able to increase that score and what if, and so we do a couple of clicks and it says, oh, if you pay down this card, $200, if you open another card, whatever it is, usually it's paying down cards, not closing them, not paying them off, just paying them down.
Right.
That my coworker's client went from 650-ish, which is, you can get a loan, to 723 or something like that. It just put them in a whole different category. So, I don't know how I got on the credit scores, but yeah. So
They're kind of important.
Yeah.
that's, yeah. And that's where, rather than driving people around your car on a Saturday and a Sunday, definitely get them in pre-qual and see.
Yeah.
That's the number one killer. And it's amazing. I'm doing one right now. He's a lobster guy. He shows, he probably makes double this, but he shows over $100,000 a year in income. Who knows what he makes? But his credit score is a mess. But the what if simulator says we could change it by 100 points on all three of them. So he's coming in next week and we're gonna try to figure that out.
I just want a second note on that. So the utilization on credit cards, you have 100% available on your cards and they add all like your limits together. That's roughly like 100 points on your score. So if you paying those down, that's 35% of your score, 30% of your score is actually capacity on cards. That's the biggest thing people have control over, trying to keep those balances down. And you mentioned again, not closing old trade lines. It's either 10 or 15% of your score goes into the oldest trade line that you have. So getting good lenders help you to make sure that your clients don't make gaffes on while they're trying to get qualified, or like Steve was saying, let's get them in the best position possible, and being able to help coach them on what to do with credit is huge.
It's silly. I mean, you could have the same $9,000 worth of debt, but if you spread that over 3 cards versus 1 card, it could be hundreds of points difference in your, you still owe $9,000.
Move it to a personal loan even too.
Yeah.
All those.
Yeah, I'm sure we could all go on a rant about how we feel about credit reports, because I know in no uncertain terms how I feel about them. But we too offer Main State housing in my company. We do FHA, VA, and USDA as well. Jason and I help teach the best housing program, first time buyer program on occasion.
As do I.
Yeah. Oh, yeah, that's right. Yes, you do. Yeah.
Just saying.
Really, I know personally, I really like working with first-time buyers. I'm what I jokingly refer to as a failed history professor. Did a master's in history and wanted to teach and realized I was going to starve to death. So the educational piece is again, I go back to that a lot, but it's just so crucial now to helping people understand their options. And talking about FHA, I probably do about 35% of my business in FHA loans. They can really open up opportunities. I know you're cringing right now.
No, I like them. I was going to tease these guys because if they see an FHA offer versus something else, guess what they're going to take?
Yeah, exactly. And
Most of the time.
yeah, and and that comes down to, again, good loan officers. We're going to call the listing agent and talk with them about the due diligence we've done. But yeah, so first time buyers, Misha, we've got all the standard options available, and again, it comes down to education, really getting them prepared to go out and shop confidently.
Right. I do want to add that what some of you have already said, I call it a pre-qual meeting, right?
Yeah,
Right?
absolutely.
Don't pull credit. Let's take a look,
Yeah.
right? One of the biggest things that I always ask is, what do you think a comfortable payment on your take-home pay would be? Because ultimately, so many of them think that the bank or the lender is going to tell them what they can afford. It's not our job, it's not our role. And so we have to get in front of that and say, what do you think that you could do? And if you don't know, let's talk about how to budget and get a sense of what that might look like for you. Because what we're doing is assessing our risk for the programs. It really on take home, not on gross income. It's apples and oranges. It's not the same at all. And so that action plan process is vital. And if you're not working with a lender who does do that, you may want to be talking to a different lender because it's vital right now for people. And it's not just first time buyers. I get folks that they've had a home before, but they really didn't know what they were doing then, right? So we're always about educating and we're always about making sure that it's successful for them. So I think all of us here have that same attitude.
Great. So, are you, any of you, all of you, seeing an increase in use of jumbo loans or adjustable rate mortgages?
Okay.
Sharon?
Yes. Because the changes that are happening with the secondary market, there's a lot of fees that they've increased. For whatever reason, I feel they're arbitrary, but whatever, my opinion. So a lot of them, a lot of folks are looking at the adjustable rates because they're not as scary as they once were. We have a product, the 10-1 adjustable after 10 years, right? The average age of a mortgage is like 7, right? So a 10-year, it's a little less than what the rate would be for a fixed saleable loan. And it can be done for jumbos as well. It's the same rate. We don't differentiate between that. And what we have is kind of cool that down to, let's say, 6 years from now, the rates, because we know this is what they do, right? Like a wave, they're gonna go back down. They can then, for a small fee, they can modify their loan to that lower rate for another 10 years fixed. So it's a nice safety net for them to feel comfortable and confident that, yes, it's an ARM, but it's an ARM with little added benefits to it. So that's kind of a cool thing that BAP does. And they don't have to refinance and pay, whatever the fees are for that, just a small origination fee. So kind of cool. So yes, I'm certainly seeing that. As opposed to, and well, my focus has been for some buyers for most like 40 years. So I don't see a whole lot of jumbo. They're not at that stage, right? So, but as an organization, we do certainly see, $1 million and 800,000 and because we cover Falmouth and Cape and some of the other areas that have homes that are really high priced. So.
I'll say once rates started creeping up, third quarter, fourth quarter last year, and with any lender conversations, people were scrambling to put ARM programs together if they didn't have them going in. Typically in ARM, you're gonna get a lower interest rate than what your fixed rates are gonna be out there. Again, I mentioned earlier that we did press pause on our ARM programs. Now I will say, like, end of last year, we were like a 90% ARM shop. So some of the things that Sharon was talking about, a big part is wiping away the misnomers about ARMs and the bad rap that they got because there's so much advantage. We would actually, similarly, you probably do the same thing. If I was looking at a fixed rate at 6%, and if my ARM was coming in even at like 5%,
right, you
can do the math over 7 or 10 years to say you're going to save 30 grand in interest or whatever it happens to be by taking the ARM. And you can modify out or use that money to refi or you'd be that much further ahead. Great for realtor community because that next home, they have that much more equity in this house because they have the ARM. I'm a big supporter of ARMs and understanding of how it works.
right.
But the demand, yeah, I have been seeing more and more come in for that. Jumbos, yes, they're out there. I don't know if it's gone up necessarily. And in Maine, again, a lot of those jumbo houses sometimes are coming in with cash.
Yeah.
I'm seeing maybe second home jumbos as trying to get that financing for the second home, vacation home potentially. But even the limits have keep going up. What are we at, like 724 now, conventional, something like that?
Yeah.
So I mean,
A lot of jumbo, it's got to be pretty big.
yeah, exactly. So no, I haven't seen it really spike or anything. I think that's stayed somewhat consistent, but not as much as people might think, even with the values of homes going up and asking prices.
Yeah, I agree. I've seen almost less jumbos. I don't know, and I think it's because
Because of the
it's
convention
720, yeah,
component.
convention, so and so 726 or whatever it is. But the good news about jumbos is they're very competitive and sometimes they're lower right now than conventional rates. So we, I have that conversation with folks if they're near the limit, the 726.3-ish for one unit. And then ARMs are great. They seem, my experience is they come in and out of the market like this. Obviously, you guys filled your bucket of ARMs and are taking because those are all going to be refinanced. So, but anyways, so yeah, I mean.
Yeah, we're seeing roughly the same thing. ARMs can be really competitive. Jumbos, we use outside investors for those products. We have actually seen a couple of investors leave the jumbo market. There's been some concern, well, and then there were some investors who they built their business on five, and when they dried up their funding away, so we lose those. But it really does seem like that every investor out there and every lender is trying to just stay as absolutely sharp as possible, knowing that interest rates are what they are right now, and they've really depressed demand. So it's all that much more important to be sharp on rates and competitive in the market.
Great. So we know that everything's going up, everything, groceries, gasoline, everything, all of it. How are you folks seeing that your fees are going up, and that you need to obviously pass those along to the buyers? And we don't know all of those, what those fees are, but you do. And so it seems to me that your fees would be going up, just like everything else is going up. Is that true?
I haven't seen it so much with us yet. We have one origination fee. We have not increased it lately. It's $9.45. That's what we get as a lender to do the work that we do. The only thing you had asked about credit reports, yes, that did go up fairly significantly, but it's like a couple is like $118. I mean, it's not like thousands.
Right.
We have agreements with our closing agents, our title companies, as to what they will charge and assess. Have not really been increased, maybe $25 here and there, but nothing huge. The biggest thing
Appraisals?
is, well, appraisals.
Yeah.
It's not horrible. Ours are still maybe 700 for full.
Yeah.
Depending if it's an island or if it's a jumbo, if it's, there's some times that it's higher. But as a general rule, it's about $750 for an appraisal.
Yeah.
Used to be, well, I've been around. Do you
Yeah.
remember- Do you remember when they used to?
Yeah, so I just said, Sharon, I remember 350.
I do remember
Yeah.
350 as well, I do, but that's been a while since then.
The appraisers, like many of us, aren't quite as busy, so they're a little,
Yeah.
they're more amenable to either getting a little bit.
Yeah, they're not gonna.
But
ask
I just had one ordered 2 days ago in Belfast. And
They wanted extra.
they put $200 extra on it, so it's a $900 appraisal for a single family, and he's gonna do it in 10 days, which.
Right, it's a rush fee.
But still, that's a lot of money in my opinion for a single family.
So yeah, you're right. I think appraisals, I'm just,
Biggest, like, gonna
like-
jump.
it was just like kind of slowly kind of started, so I'm kind of used to it at this point, but you're right, compared to what it was 5 years ago.
And it wasn't the shift. I mean, I think basically your question goes back to like right now, with
Currently,
this
yeah.
sharp inflation that we're seeing with everything going on. It hasn't really had an impact on the costs that our borrowers are gonna have to be taking on. Again, our origination fees have stayed the same. Credit, you might see small fluctuation. Appraisal, I saw some shift. Again, we're in that same $700 range. It would depend on the AMC that you're using
Right.
and their pool of appraisers. If they're coming from out of state, you might be paying double that or getting quotes. So I would
Right.
definitely recommend having your lender put your AMCs to task to make sure you're working with local. Because you can go back and try to get that someplace else.
Appraisal management companies.
Yeah,
AMC appraisal management.
In the old days, we would call an appraiser and say, hey, get out to 123 Maple Street.
Yeah.
We need it in 7 days, or don't think we're gonna get any more business from us, but now we have to all go to appraisal management companies. And
Yeah, they gotta
they
keep
wheel
it.
it up, yeah.
Some bad players a couple of decades ago.
Well, that's true, that is true. Yeah.
Well, and going back to the fees in general, like I mentioned in the introduction, we got a huge servicing portfolio, which drives most of our revenue. So we've been able to sit on our fees as well. Our origination fee hasn't changed, I think, in a couple of years. We're not having to increase, but we do know of some lenders who've had to because they're making their money on selling the
Right.
loans on the secondary market, and the loans aren't worth, if they were worth, just for sake of argument, if they were worth $1 a year ago, they're worth 75 cents now. So that's a 25% reduction in their income that they're going to make up elsewhere. So they have changed for some lenders.
Okay, that's good information. The reason I asked really that question is because when the market was super hot, I mean, like, 50 offers on a property and whatnot. We were seeing appraisal fees come in because they were so busy, $1,700-1,800 an appraisal.
No, we've never had that.
And so, yeah, it was crazy.
Terrific. Yeah, no, they were running the show. They were
Absolutely, absolutely.
Yeah, so
Maybe a month out,
for sure, yeah,
if
exactly.
we're lucky.
Yeah.
But now they're pretty good about getting it turned around.
Yeah, they're
Yeah.
they're a little more bored these days.
Exactly, I know, I just had one turnaround in a day.
Wow, that's
He
great.
was there Tuesday, I got the appraisal. So,
That's awesome.
wow.
Yeah, I had an FHA one do that.
Wow,
Yeah.
that's amazing.
Yes.
So I think what I'd like to do now is open it up for questions, because I feel like this is such a timely lunch and learn with what's going on in the market, that maybe there are just extra questions out there that folks that are burning to ask. So if y'all are okay with that. Julia.
So, I have 2 questions for everybody. One is, are you seeing bridge loans? Or are you offering bridge loans and, because it's just so hard to, buy in this market, and I'm just curious to hear how that is working,
And why would you, this is a rhetorical question, but why would someone you're saying it's a hard market, why would someone need a bridge loan?
Because if they have to sell their house in order to buy another one, they won't be able to get that contingency.
Conversely, you're saying
Right.
buy before you sell.
Right.
Yeah.
Right. Yeah.
Great, and that's what we're all,
Houses
so
sell
much,
quickly, you have nowhere to go.
Right.
because
Yeah.
you can't
exactly,
sell it.
right.
Yeah.
That's the biggest, like, that's one of the changes in 6 months, like,
Oh, yeah.
no one is selling and then gonna go right
Yeah,
now.
there's no contingency for that.
So I don't do bridge loans, some, I prefer to look,
Yeah.
some local
do.
banks, you don't,
No.
yeah, so, and
Typically, we'll
it's
look for
such an
local
easy,
banks. Yeah.
yeah, it's a term that sounds great, and stuff, there really aren't that many out there, and you and I talked about that, I think, and I'll let Sharon
We
talk, but
actually,
so
yeah,
we always say is get a home equity on your existing home.
Right.
You can even,
that's all
do-
it is. That's what
well,
we're
it's a home equity, there used to be a bridge loan where you
doing.
can.
Well, we do still have one on the books. I've not done it. yet,
Right,
yes.
so have your clients get a home equity loan on their existing home as soon as possible, once you start meeting with them. Many of the banks will do it even if your house is listed.
Oh, yeah.
They usually did, they used to not do that, but they will now, and there'll be a small fee when you pay it off quickly, but
No,
no,
Mhm.
no,
no,
And how long, what's the turnaround now?
couple, 3 weeks.
yeah,
maybe.
I'd say 3
Oh,
weeks,
yeah.
yeah. And minimal, low to minimal closing costs
Right.
and, yeah.
Yeah, there's a reason why typically like a financial institution versus like a mortgage broker, you guys typically have first mortgage solutions, not necessarily home equity. Sometimes you can tag into that, but I'm not surprised to hear like we both could do the bridge loans because they're basically built as a home equity line of credit solution, something along those lines. So we can put it out, turn in, 2-3 weeks, interest only payments.
Right.
So make that
Only
convenient until they
when
sell.
they use it.
Yeah, exactly.
So
Like when
They can have the line and sit there and be looking for property.
And not pay
Very
anything.
minimal
Yeah.
Just have it
cash
ready to go.
outlay. And just have it ready to go. Yeah. Yeah.
So
Don't know
I
what
would
to-
say that's not a bridge loan, you guys are saying
I
it's
know.
really home equity loan, right, it's on your,
Yeah. And
on
we
any
can do
home you
that.
have. home.
And it's easier than a bridge. We do actually have it on the books that we do bridge loans, but literally, I've been there at Bath for 8 years. Never.
Yeah. Yeah,
Cause it's got a lot of other layers to it, and it's like, why? Let's
so
do it.
the big answer to that, I would say no, there really aren't many bridge loans out there, but there's ways around it.
There's
Yeah.
ways around it, For sure.
And do you
and
have
I
to have
seen
enough
it.
equity to actually purchase
Yeah.
the other?
Many of them
property?
do. Yeah, many of them do. Or sometimes it's a matter of accessing, I just talked to someone yesterday about this. Accessing the equity to be able to do the down payment. With the understanding that that's gonna be, and it's a mitigator. Like, we know that the house is gonna be sold, so maybe the debt to income is a little higher than what we would normally like to see. But we know that the home is gonna be sold. And so we're able to kind of work with that, and be flexible.
But the home equity lines of credit will go up to 80, maybe 85% of the
Correct.
value of your home. So you're
Combine
gonna
it.
have, and let's just say you have $100,000, that equates to $100,000. They make the offer, they use that 100,000 for the down payment or closing costs, or whatever, then they sell, they got another 400. They can, and they want to apply some or all of that, they can do they can do that, then they come in and it's called recasting,
Right, we do
whatever,
that.
you want, and you
Yeah,
can do
and
that,
lower
yeah.
their payment.
Conventional.
And I also say, this just happened to my clients who did have a line of credit and the title company shut it down so quickly when they, they.
Made the appropriate payoff.
So we had to go through this whole process because they needed to get that money out to buy, to put down on the when they were buying. So we had to undo because the title company went boom like that. And it's like,
No.
When they call for the payoff, sometimes they. Yeah, yeah,
remind your clients and
yeah, that's
Yeah.
great, that's a great.
in the process.
That's-
And just to follow on, because I'm pretty broker. Anybody doing any kind of, loan that takes into account the ratio of a very energy efficient home where, the buyer is not going to be paying very much in monthly utility costs. There's there's a Panelists product, there's a,
The energy efficiency
yes,
situation.
anybody,
Well, we're a
underwriting.
Freddie shop, so I haven't seen that. I mean, we
there is a
certainly,
pretty.
right,
Yeah.
so I haven't
Green
seen
choice, I
anyone,
think.
right. I haven't seen anyone who has asked for that, would be open to doing that.
It's a very chicken and egg thing.
Yeah.
We're just not we're not a stronghold of that kind of thing. There are other pockets in the country that are, but we not. And so nobody knows to ask for it.
Right.
And
Well,
when they do
consider-
ask for it, they're given a 203K.
Oh, yeah, which we do.
Yeah, that's a great question. I would say in general, our industry is not great, has not caught up to green homes, to net zero homes.
Right.
I did one 4 or 5 years ago and the appraiser like, we can't find a comp, it was a
Yeah.
net zero.
I've had some
but it-
construction loans that were that.
But
and-
I think we will get there and we're a Fannie Freddie, we can do either, and I've never done one, I don't know much about it, so I should go to your seminar.
So Waypoint Brokers Collective, we're the only fully green certified agency in Maine, and that's what I work with. But North Point is very well versed in mortgages in this area.
Okay.
And
I'll take a
then
look.
if you do have a home that is certified, whether it's PERL certified or LEED certified, you can ask specifically for an appraiser that has gone through that training. They're going to come from Massachusetts. I think there's 1 or 2 in Maine, like there's not that many. But there are resources here where people are qualified and understand, a high performance home and what that
Thank
can look
you.
like.
That's awesome, yeah.
Yeah.
That's great.
That's not the point. though. I was just wondering if they had a loan product
Right,
that reflects it.
right.
Yeah.
I'll look into
It's a
that.
really good point.
I don't know anybody.
I'll look into it.
With the construction loan, like you mentioned.
Yeah, so,
Geared towards that?
no, the construction loan was construction loan, but the issue was comparables, right?
Yeah.
Because the cost is so much more to do the flooring and, all the different pieces that they do. And so we did end up getting an appraiser who understood all that and was able to give the value.
Upland should that. Green is very
Rockland.
important.
Okay. Yeah, this
We're
was
certified green.
All right, good.
good to know.
So are you guys familiar with LD 1080, which is an act to require the termination of private mortgage insurance in Maine? And it's based on 80%, 80% value. And 2 years, whichever would come first.
Right.
I know the Mortgage Bankers Association's been opposed, so I guess my question is, what kind of impact does that have on you, resale loans, things like that, if you do, and are you aware of it?
I think I've heard a little bit about it. Ours is such with PMI that it is a 2-year minimum. If they want to, after that point, if they want to pay for a new appraisal to see what the value is, we'll certainly look at that. But we do have that 2-year requirement for those who have PMI, whether they're portfolio products or we're servicing those that we've sold to Freddie. So, but it is 80. I mean, we do have it as in our system.
At
to produce.
80 or
at-
78? Just
I
most
thought
of
it said
them.
80, but
Yeah.
I'd have to check for sure.
It's usually 78.
Yeah.
Paul, you had forwarded that to me.
Yeah.
And I don't know if you guys have heard of that before, but it sounds wonderful and Augusta, sounds great. It's good for the consumer. Problem is, it's not a fit, it's kind of like the marijuana laws. We can't do a
Yeah.
loan, we can't do a loan. If you work for a pot dealer, you're fine. If you own the pot plant, you
Not
can't do
even
it.
for us. You can't even do it if you work for someone.
Yeah. No owners to me, but so it's great. If that passes, I know, are you feeling a momentum that could pass? Because it sounds wonderful, but
I think
no federal loan will adhere to that.
So
secondary.
Right. Yes.
Is if it were to get enacted, which sounds great on the surface,
Yeah.
like anything. The problem is the private insurance would go up in order to accommodate a main loan,
Good point.
Yeah,
That could, yeah,
you know? Because the other problem is banks want to sell their loan so they can have another loan to sell.
yeah.
Right.
Well,
And if
Freddie
they can't
loans,
resell it because of
Yeah.
bad
That's what I mean.
losses,
Right.
then
No,
it could be a
100%.
real
Yeah.
problem.
Yeah, we talked about this a little bit, Paul, and you nail on the head right
Right.
there. I mean, it's just gonna throw an extra monkey wrench in where it's not really needed right now. It's just political. It feels like
And,
it.
and God forbid we go into a declining market. What does that
Right.
mean?
Yeah.
exactly,
I'll be doing-
yeah, I think,
Oh, Matt Pulo.
Glenna, I just would like to ask about, from the finance, we have to this, the ADU.
oh, I can address that.
Well, so what I was gonna ask, of course you can, Sharon.
He's that one.
Walking encyclopedia, because I've known him for 30 years.
Yeah.
So, yeah, I want to elaborate a little bit on that. I'm hearing a lot of different things on the street, locally and from Augusta, so.
Sure.
Maybe you can elaborate with the financing piece of that, that'd be great.
Sure. Absolutely. So, ADUs, that's three dwelling units. The state, and probably Paul can talk more about that, but, they opened it up statewide for municipalities to really look at what their zoning is, what their rules are, the requirements, and do what they can to loosen those for folks to be able to do an ADU on their single family home or even a multi that they own. Because we're all feeling that crunch of affordable housing, it just isn't enough. And so this is seen as potentially at least one sprocket of help to go toward that. And so actually just for South Portland, they just did something last week at the library about this whole process. And I actually spoke about the financing piece. So I have 9 steps for successful ADU financing. I'm actually, I have it as a Word doc.
Of course you
and-
do.
But,
Yeah,
but
anyway.
what does that even mean? So are you talking about the appraised value?
So
Or are you
this is-
talking about
yeah.
using the income to help qualify?
No, I made it clear that most lenders are not gonna look at income to qualify.
We can't, I mean, we
Okay.
just,
I
we're
said
doing
most,
that,
I
yeah.
didn't say-
No, but I mean,
That,
I think is and that would question what, you can for a 2-unit use the income, why can't you for an ADU? And that's,
Yeah.
again, our industry has to catch up with green and with them.
it's no
I think-
history. That's
What
what
they're
they're like
assigned
here.
lease, yeah, exactly, I mean,
Yeah,
it's-
yeah. So, because it's not built yet, right?
Right.
So we don't know.
or some of them are,
Yeah, well, if they are, then that's a whole different thing. Right?
Right.
I'm talking about building. Building.
and,
so how can you
and we're
finance to
in,
Oh, good.
and, well, because an appraiser could say market value
Yeah.
rent for this,
They
for
could.
some,
And
but
then-
were you, I know,
I know it's just being. a
are you
little
talking about
conservative.
appraised value?
So what I talked about was the different ways, depending on where that person is. For their current value of their home, what they have outstanding for a mortgage, if any. What the plan to do, how much, sometimes all they need is like $75,000. And they can do that with, a second mortgage or even a HELOC.
Gotcha.
They might have to do a construction loan. And what does that mean, right? And so it would be an after.
you're saying
completion value.
building an ADU.
So,
Finance.
yeah.
Put
building,
finance
that's
in
what I'm
it,
talking
sorry.
to build an ADU. And so it's very individual, but there are certainly finance options for people to look at.
And that's my question to all of you was, are there financing options
Gotcha.
for that, and can everybody do that?
Yeah. And it's not gonna be, frankly, yeah, not everybody's gonna be qualified
Right.
to do it, right? You have someone who's retired, they get 2,000 a month, as income from Social Security, they want to do ADU to increase their income. and it's gonna cost $150,000, may or may not
Yeah,
be eligible for that.
or
Um,
make economic sense.
Or make economic sense, exactly.
Yeah.
So it really is a case by case. But I think as lenders, we have to be open to that, to see what we can do.
Awesome.
So, yeah.
That's a very good question, and I would say, you know, maybe some local banks, but I don't
Yeah,
think any
community
secondary
banks,
market, there's been no discussion on financing of ADU on a secondary.
Right,
market.
especially the building.
Yeah, build-
Equity, sort of second mortgage. equity.
So
Yeah. oh my God.
You do a construction loan for an ADU
Yep.
and still have a primary mortgage?
Generally, it's gonna have to refi into the first mortgage. Generally, it depends, like if they have a first mortgage with us. And then they want to do this as an ADU and can financially qualify for both, we may consider it,
Yeah,
If
and
we're holding
again,
it
an equity line would be the way to go, if possible.
if possible, depending on what's going on.
Yeah, thank you guys.
all right, we have about 4 minutes left, so what I'd like to do is just everybody who hasn't eaten food, chit chat lenders for a few minutes, if you guys are willing
Before,
to stay for a
before
couple
we do
minutes.
that. Glenna, I'm gonna do another pitch. Homeownership education, there's brochures, please take some back to your shops. This is a way that you're gonna have successful homeowners, successful clients. 8-hour course, very low cost, it's neutral environment, they're not being sold anything by anyone. And the organization has been around, it's a volunteer board made up of all sorts of industry professionals. I am actually treasurer, I will tell you. I'm one of the original people in 1999, and I'm still on that board because I feel passionate about making sure that folks know what the players are. 20% down versus 0, that kind of thing. Yeah,
I would second that. And I was just about that class.
Yeah.
See first-time home buyers, who have habitat, while, you know, like they.
yeah, you can tell. You can honestly tell. Absolutely, you can.
Can you just say really quick, who is taking out mortgages now? Is it first time home buyers? Is it, you know, people from the state? Is it, you know, this is kind of who
All of the above.
Yeah.
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 It's,
First,
yeah.
Sure.
I'll say the demand rate there is still up, whether you call it 25-30% of our demand for first time home buyers, but they might only be getting closed 10-15%. I mean, that's less than what the
Yeah.
demand is because they just can't find the properties that fit their qualification.
Or if they do, they're not chosen.
Well, yeah,
Right,
it's,
yeah.
it's also,
Or they're
we're
not
still in, as agents, we're still in an extremely competitive market whereby you're showing a home and you're putting an offer in and you're going above asking and you're trying to waive as many contingencies as possible and you're still not getting selected. So it is, you know, financing is one component of it. And I certainly love the program that you're presenting, Sharon, but
They're not gonna
trust
get
me when I tell you, your jobs are harder than ever. There's financing education and then there's
The market,
the
yeah,
market
negotiating, yeah.
education. And if you don't educate your clients, they're never gonna get the property. So, you know, telling them up front, this is how it is, you know, this is what it is, you know, and really the reality of what's going on out there, because it's hard for first-time home buyers to even conceptualize that this actually exists. This really is. I have a first-time home buyer. They put 8 offers in. They finally did get something under contract, but they can't wrap their heads around what goes on. Like we went 50,000 over asking. Why didn't we get it? And I'm like,
because it was a cash deal.
it's exactly what it is. Yeah.
So
So,
just to segue what you just said, I'm working with a realtor now. She just sent me this. If anyone's a realtor, they recognize this. She had set up a lot of showings this weekend, out of state people.
Hmm.
Okay, set them all up, everything.
House
Declined,
contract.
declined,
Yeah.
declined. All the showings she had set up, she got.
they're already
back
under
saying,
contract.
All of them declined, they're all under contract.
Sure.
Within just a couple days.
Yep.
And now these people are coming from out of state and she doesn't have anything to show.
To answer, I had 3 closings last week. They were all out of state people.
I'm working with I'm working.
And I think and some had, two of them had connections to the state and one didn't. But I don't know why that is and they weren't big volume. They
Was it like big money?
it wasn't huge money by any stretch. And I don't know if they're just more willing to go over asking or, hey, we got to get it done because we're, we have jobs here or
I think
whatever.
You're coming from places where our prices still look.
Good.
Okay, yeah.
Yeah.
And they could
Although
look
they're
for
getting, they're starting to reach Boston, numbers.
Yeah,
But I think that they come already.
ready to go.
Yep.
Ready to, I've got a guy trying to buy $1 million condo in Portland. Because his son is going to Bowdoin and they want a place to stay when they go visit their
Oh,
son in
my God.
Bowdoin.
Yeah.
He lives in California and he doesn't understand the market and his realtor trying to say, he's made 2 or 3 offers, Chandler's Wharf and somewhere. And he won't go above list, they're not going above listing.
Yeah.
They're
They're
he's
never
not
gonna
getting
get
it. I know, but they're at the $1 million price range.
Like you're
Yeah.
eight times.
Yeah.
From
They'll figure
where
it
they
out.
were the
Yep.
first offer to where they are the.
Oh,
We'll give away the
exactly.
store, we're gonna,
Yeah.
it's the, I'm damn it, I'm gonna win.
Yeah.
That- Well, that's, I'm gonna win no matter what, are the exhausted people.
Yeah.
Exhausted. And then
they
to my
make-
point of not being as much fun, because they're exhausted by the time they are under contract. And they could be making bad choices.
And we haven't even addressed the tired inventory that's out there.
Oh, yeah.
Purchase plus improvements and all of that.
That's all of
We're
what's
done.
really on.
So, yeah, it's crazy.
Those two, yeah.
But thank you, guys.
Uh,
Thank you.
Yeah, yeah.
Thank you.